Welcome to The Explainer. Today we are decoding one of Canada's most dreaded forms, the T1 Personal Income Tax Return.
You know that feeling, right? Tax season rolls around and suddenly there's this wave of dread. It just feels like this huge, complicated mountain of paperwork and confusing rules. But here's the thing. What if I told you it's actually way simpler than it looks? That behind all those boxes and line numbers, the whole thing, it really just boils down to 3 simple ideas. Get these 3 things, and you've basically got the whole system figured out. And here they are. This is your roadmap. It's all about your income, your deductions, and your credits. Think of it like this. First, you show what you earned. Then, you use deductions to shrink that income number down. And last, you use credits to slash the final tax bill itself. That's the entire game right there. Understanding how these 3 parts work together, that's the key. All right, let's jump right in with the first piece of the puzzle, your income. This is the starting point for, well, everything. So, the government wants to know about all the money you made. And we're not just talking about your 9-to-5 job. We mean everything. Employment income, pensions, any money you made from investments, rental income, you name it. And the good news is, for almost every single one of these, you're gonna get a little piece of paper, a tax slip, to help you keep track of it all. And here's a look at the most common ones. See how it works? Your T4, that's for your main job. The T4A might cover pensions or self-employment income. Got a T5? That's your investment income. The whole system is basically set up with these codes so you can easily match the slip to the income source. It really does make it a lot easier to make sure you're putting everything in the right spot. Okay, so once you've tallied up all your income, we get to the next step, and this is a really important one. We're gonna talk about how to make that income number smaller. This is where deductions come in. Now, this is probably the most important thing to get straight, the difference between a deduction and a credit, and this analogy is perfect. A deduction is like a store-wide discount. It reduces the price of everything in your cart before you even get to the cashier. It shrinks your total taxable income. A credit, that's like a gift card. You use it at the very end to pay the final bill. 2 totally different tools. So think about what that means. When you claim things like your RRSP contributions or childcare expenses, you're not just filling in a box. Nope. Every single dollar you deduct here lowers the amount of income the government can even look at. That's huge. It can actually lower your tax bill by pushing you into a lower tax bracket. All right, now let's talk about that gift card. This is your second powerful tool, tax credits. Remember, deductions lowered your income. Credits lower the actual tax you have to pay. And these are so powerful because they go right after your final tax bill. We're talking about things like medical expenses, donations you've made, your tuition. All of these get turned into credits that just chop down the tax you owe. In many cases, it's a dollar-for-dollar reduction. Pretty amazing, right? Okay, so you've got your income sorted, you've found your deductions, you've claimed your credits. You're almost there. The last piece of the puzzle, you've got to get it all in on time. You'll want to put these dates in your calendar right now. For most Canadians, the big day is April 30th. That's for filing and for paying. Now, if you or your spouse are self-employed, you get a bit of a break on filing. You have until June 15th, but, and this is a really big but, your payment is still due on April 30th. Don't forget that part. And why are these dates so critical? Well, because the second you're late, the CRA can start hitting you with interest charges on what you owe. Not only that, but they can tack on late filing penalties too. It's just a really easy way to end up paying more than you have to. But when you really get these 3 things, income, deductions, and credits, it completely changes the game. You stop feeling like tax season is something that just happens to you. Instead, you're in the driver's seat. You're in control. You can actually plan ahead and look for ways to minimize your tax bill. You're taking charge of your money. So, this year, when you sit down with your T1, try to see it differently. It's not just a bunch of scary forms. It's a formula, a puzzle, and now you know the pieces. So the question is, what's the first deduction or credit you're gonna go searching for this year?